So in order to get to the margin of safety, hey, man, we got to know what this thing is that we're buying, right? And we got to know what it's worth. So here we go. So number one, I want to remind you that price is not the same as value. And this is one of the great insights of Warren Buffett and Ben Graham. And
hey guys, and welcome back to the channel. We're up to the final video in the series where we learn how to invest in stocks and how to beat the market, which as we know by now is buying a wonderful business at an attractive price. The first 3 videos in the series were all about how to know if a business is wonderful. And to top off the series, we're going to be looking at the 4th and final aim, which is margin of safety. This video is all about how to find out if a business is selling for an attractive price. So how do we know if a business is on sale or not? Well, according to Phil Town and many others, in order to know if a business is on sale, we need to know what it's worth, which is a process known as valuation. Valuation to a lot of people is the most important part of this framework. Paying too much for a company can destroy your returns and cause you to lose money, which is breaking the first rule of investing. Let's say you were buying a house, not as a home but as an investment property to sell for a profit in a few years. The true value of the house and the price that it's selling for are 2 completely different things. Let's say you did a valuation on the house. It's a nice house and you believe it's worth 500,000. That's your estimate on what it's worth, and you believe that in 5 years you can sell that house for 800,000. So how much do you pay for the house? Let's say it's selling for 500,000. That's what you think it's worth, so that sounds like a good deal and you'll probably make a nice return when you sell the house in 5 years. Now what if the house was selling for 900,000? That's nearly double what you think it's worth, and based on your estimate you'll actually lose money when you sell the house in 5 years. If somebody else went to buy the house and they didn't know the true value, they would assume that the true value of the house is 900,000 because that's what it's selling for. And they'll be in for a rough surprise later on. So price and value are 2 separate things. And it's the exact same with businesses. The true value of the business is different from the stock price. And being able to calculate the true value of a business is so important for knowing what price to pay for a company's stock. So valuation is all about knowing the true value of a business and never paying more than it's worth. There's a few terms investors use to say the true value of a business, like intrinsic value or fair value. So from now on, when I say intrinsic value, I'm talking about the true value of a business. There's a few ways to calculate intrinsic value, and I'm going to show you 2 ways in this video. But in essence, it's this. If you're a business owner looking to buy an entire business, a superior business to own would be one that produces the most cash for you as an owner. Remember in part 2 how we said we wanted businesses that were predictable? Well, this is why. Calculating intrinsic value is being able to predict how much cash a company can generate between now and the end of its days, and how much to pay for that future cash today. So now that we know what valuation is, what is margin of safety? Essentially, margin of safety is like a safety net on your investment. It's a protection against miscalculation, because when you're estimating the intrinsic value of a business, you're basically estimating how much cash a company can generate between now and in the future. And we can always be wrong when predicting the future. And margin of safety just gives us an extra layer of protection. That's why understanding the business and the business being predictable are really important to being able to calculate the future of that business. But that's not enough. Investors like Warren Buffett, Phil Town, Nick Sleep and Monish Pabrai all agree on one thing unanimously. You must always demand a margin of safety, like Ben Graham first said in 1934. And a margin of safety protects you against messing up with your calculations of intrinsic value. Margin of safety is one of the most important parts of buying stocks and succeeding. Learning how to buy $1 for 50 cents is the key to investing according to all the greats. Remember buying $1 for 50 cents as a motto to live by when investing. So in essence, whatever your intrinsic value calculation for a business is, you just divide it by 2 or cut it in half, and that's your buy price. So with our house example, remember when we said we thought the value of the house was 500,000. By demanding a margin of safety, you would not pay more than 250,000 for that house. 2 reasons. 1, your calculations might be wrong and the house might not be worth 500,000, and you're protecting yourself from overestimating the value of the house. And 2, if you're not wrong about the value of the house, then your returns will be insane. 500,000 to 800,000 in 5 years is really good, but 250,000 to 800,000 in 5 years is unbelievable. And that's basically what all the greats do. Now you might be thinking, no way would a $500,000 house ever sell for 250,000 and then go up to 800,000 in 5 years. And in housing you're probably correct, but it does happen a lot in businesses, and you'd be surprised how many times a business is selling for far less than what it's worth. And then months or years later the market realizes and the price shoots up to its intrinsic value and maybe beyond. Monish Pabrai says in his book The Dando Investor that you want to focus on mispriced bets that are low risk and high reward. He outlined a great point when he was touching on Ben Graham's margin of safety principle. He said the bigger the discount to intrinsic value, the lower the risk. And the bigger the discount to intrinsic value, the higher the return. Low risk and high reward can go hand in hand by buying wonderful businesses for far below their intrinsic value. Okay, so we know that intrinsic value is the true value of a business. And margin of safety is buying a business for 50% of its intrinsic value, or buying $1 for 50 cents. Now let's move on to how to actually calculate intrinsic value for a real business. There's two main methods that investors use to calculate intrinsic value. One is an EPS multiplier and the other is a discounted cash flow. And I'll link both of these spreadsheets in the description box below. The first one we're going to look at is an EPS multiplier, as it's the one that Phil Town uses in his book Rule 1. So for our first example, I'm going to use Nvidia, as we've been looking at them the entire series. And this is just an example. This is not a buy or sell recommendation for Nvidia at all. So to do this, we need 4 numbers and I'll be putting them into a spreadsheet. Current EPS, or earnings per share. EPS growth rate, which we can get from our big 5 numbers, or we can use our own estimates. Future PE ratio, which we can estimate using their PE ratio from the past and present. And finally, required rate of return, which will be a standard 15% no matter what. The reason we have 15% is because that's the minimum acceptable return for taking the risk by buying companies. We won't settle for 10% because we could get 10% by buying the whole market and not going through this effort. So 15% is the return we're after if we want to beat the market. And at the end, you'll see why 15% is critical to this calculation. So before I begin, I'll explain how it all works so it's easier to understand as I go along. Essentially, we're taking the current earnings per share and growing it out 10 years into the future using our growth rate. And then we use a future PE ratio to get the future stock price of the business in 10 years. Because after all, a PE ratio is just a multiple of the earnings. If the earnings per share in 10 years are $1 and the future PE is 20, then the stock price in 10 years is $20. If the future stock price is $20, you just subtract 15% per year for 10 years to get today's intrinsic value. So let me show you a live example from Nvidia. First, let's get our current EPS, which you can find from QuickFS. So we can see that our current EPS is $1.73. Next, we need our EPS growth rate. If we go to our big 5 numbers from part 2, we can use these numbers to estimate the growth rate of the earnings into the future. Phil Town says equity growth rate is the most important one to gauge the future, not the EPS itself, funny enough. So looking at both the equity and the EPS, we could probably assume that the earnings are going to grow by about 20% a year. So I'll fill in 20%. Next, we need our PE ratio in 10 years. To do this, we can use their past PE ratio, their present PE ratio, or we can just double the growth rate. Whichever one is the lowest, I'll use to be more conservative. So if we go to QuickFS, it shows their current PE ratio is a massive 76. If we look at their past in key ratios, they've fluctuated a lot in PE over the years, being as low as 15 and as high as 76. So to be on the safe side, let's meet somewhere in the middle and estimate a PE ratio in 10 years of 30. So whatever the earnings are in 10 years, I'll multiply by 30 to get the future stock price. So as you can see, the calculator has done its thing, so let me explain how it got these numbers. First, we need to get the EPS, or earnings per share, in 10 years, which is $10.71. The next part was multiplying our future EPS by our future PE ratio to get a future stock price of $321.35. So that's $10.71 in EPS multiplied by 30. And that's what we estimate the stock price to be in 10 years. Next, we need to find out the intrinsic value today. And this is where our 15% return comes in. In order to find out the price to pay today, we need to subtract 15% per year to this 10-year future price, if we want a 15% return per year for owning it. And there's a really simple way to do this because of the rule of 72. The rule of 72 states how many years an investment takes to double at certain rates of return. So if I bring up the table, we can see that at 26% our money is doubling every 3 years. At 7% it's doubling every 10 years, and at 15% it's doubling every 5 years. So that means over 10 years at 15% our money doubles twice. We can actually invert this logic and say that if we wanted a 15% return on the stock, you can invert the 2 doubles in 10 years and just halve it twice to get the price today. Or you could simply divide it by 4. This is a really helpful little trick because it cuts out a really hard part of the calculation. Because if we want 15% per year and we have the stock price estimate in 10 years, simply dividing the amount by 4 will give you today's intrinsic value. And that gives us an intrinsic value of $80 per share today. To get our 50% margin of safety price, simply divide the intrinsic value by 2 and you'll get 40. So to buy Nvidia shares for a 50% discount, I'd need to pay $40 or less. And if we look at the current price, we can see it's over $200. well above our margin of safety price. Now, to Nvidia's credit, they're 10 months into their financial year and they're about to report this year's 10K, so I guarantee their actual current EPS is much higher. According to analysts, they're set to report up to $3 in EPS. And we only used $1.77. If I look at my current example for Nvidia, it's much different. So you may have noticed I have 3 cases side by side. I, like many others, do this because when you're predicting the future for a business, there's a range of possibilities that can occur. They may grow faster or slower than you predict, so I like to do a base case, a best case, and a worst case scenario for most businesses. If we look at my current Nvidia example, on their base case, I have an intrinsic value of $280, far above their current price of $220. But my 50% margin of safety buy price is only $139, so it's still a little bit expensive. If Nvidia only grow their earnings by 15% and have a PE of 30, their intrinsic value is only $90 a share, a massive difference from the base case. I think it's unlikely, but it could happen. And for our best case, if they grow earnings by 30% and have a PE of 50, their intrinsic value today would be $500 and a 50% margin of safety price would be $250. Which, if we knew for certain this was going to be the outcome, this would make Nvidia significantly discounted today. So as you can see, your estimates for intrinsic value will greatly depend on what growth rates you see the company achieving and what PE you think it will be at. It's good to try to be conservative with future estimates and not get carried away. I personally believe Nvidia can hit 30% per year. In fact, I think it's more likely than the 15% outcome. But to me, 25% growth rate and a lower PE is a happy medium. So Nvidia's intrinsic value is roughly $250 to $300 a share, according to my estimate, which would make it pretty fairly valued. The reason I put 25% growth rate in my calculation was I believe the ARM acquisition will add tremendous value to Nvidia. Okay, so let's move on to another example. If we look at Corsair, another gaming company, it's a much smaller company that's primarily hardware focused, meaning they usually have a much lower PE ratio, closer to 20. At a 20% growth rate, their intrinsic value is around $50 a share, and their 50% margin of safety price is $24 a share. And right now they're currently trading at around $25 a share. However, if I'm wrong and they only grow earnings by about 10% a year, then their 50% margin of safety buy price is only $10 a share. So again, the growth rates massively decide the intrinsic value estimate. So that's it for the EPS multiplier, which is Phil Town's way of doing a valuation for a business. If you have any questions about anything I said, please let me know in the comments down below. Okay, so for our next method, we're going to be looking at a discounted cash flow, which is the valuation method used by Warren Buffett, Nick Sleep, and Mohnish Pabrai. And it's by far the most common method to do valuations. It's not too different from the EPS multiplier. The only difference is it grows the free cash flow into the future instead of the earnings per share. So let's open it up and have a look. So like the last one, the only boxes we need to do any inputs for are the yellow boxes, and the calculator does the rest for us. So again, I'll explain how it works and explain what each input means before showing you some live examples. Now before I begin, I want to talk about the concept of keeping it simple. In the book The Dando Investor, Mohnish Pabrai brings up the quote from Einstein about simplicity. Einstein says there's 5 levels of intelligence: smart, intelligent, brilliant, genius, and simple. It's human nature to complicate simple things, but the smartest people are the ones who can simplify complicated subjects and make them easier to understand. It's a trait that Warren Buffett, Mohnish Pabrai, and Charlie Munger all have. As you start learning more about investing and about valuation in particular, you'll find there's people who have the most complicated and sophisticated valuation methods with dozens of charts and calculations. The best investors, though, they keep it relatively straightforward and simple. Warren Buffett's discounted cash flow model is so basic he can do it in his head. So remember, the highest level of cognitive ability is the skill of keeping it simple. So with that said, let's move on to the spreadsheet. First, we have our free cash flow for 2021, and we're going to grow it out 10 years into the future using our growth rates below. This time we'll be using 2 different growth rates as it's a little better for projecting into the future with more accuracy. So we have a growth rate for our first 5 years and a second growth rate for the next 5 years after that. Next we have our discount rate. Again, this is one of those figures that can be overcomplicated, but I like to keep it simple. Essentially, you can think of discount rate as the number you'll use to discount the future cash flows back to today. Think of it as the return you wish to generate on those future cash flows for the risk you're taking. Most value investors, including myself, use 10% for great businesses and 15% for risky and more speculative businesses. Next, we have the terminal value. There's many intricate ways to calculate this, but again, I like to keep it simple. So I just imagine that I can sell the business at the end of 10 years for a multiple of the free cash flow. I like to use 10 for lower quality businesses, 15 for stable, high quality businesses, and 20 to 30 for high growth and high quality businesses that have long runways ahead of them. And last but not least, we have the shares outstanding. This takes our intrinsic value market cap and divides it by the total amount of shares to give us a per share intrinsic value. So let's do one for Nvidia. So first things first, let's get the tabs we need open and ready. Now in the last couple of videos to get our financial data we've used QuickFS. But this time around we're going to be using Ticker, and I'll explain why in a little bit. And for our second tab we want Yahoo Finance. Okay, first we need Nvidia's free cash flow. We can use either last year's free cash flow or try to estimate this year's. Because we're closer to this year's earnings, I'll use that instead of last year's free cash flow. So to find that in Ticker, go to Estimates, and what we can do is we can use the analyst estimates of this year's free cash flow. You'll know if it's an estimate or an actual figure because it'll say A for actual at the top or E for estimate. So I'll drag the bar to last year's actual figure and go from there until we have one actual and two estimates. And just scroll down until you find free cash flow. As you can see, last year's free cash flow was 4.7 billion, but this year they're estimating they'll do around 9.7 billion. More than 100% increase. It's really important to be aware what point of the year you're in, because whether I use 4 billion or 9 billion in the spreadsheet will make a massive difference in the intrinsic value. Using numbers that are a year old can mess up your calculations dramatically, as can using numbers that are a year into the future. You want to get as close to the present as possible. Because we're currently in November, we're 2 months away from Nvidia reporting their next full year earnings. So it'll be much more beneficial to use this year's estimate, which is 9.7 billion. Because it's an estimate and we want to be conservative, we'll do 9.5 billion in free cash flow. Next, we want our growth rates. We can estimate these ourselves based on the big five and our understanding of the business, or we can use analyst estimates. If we go to Yahoo Finance and search for Nvidia, we can go to the analysis section to find out what the analysts are projecting for the next 10 years. So scroll all the way to the bottom and you'll see growth estimates. As you can see, the analysts are projecting massive growth for Nvidia. They estimate Nvidia will grow by 32% in the first 5 years and continue to grow by 50% for the next 5 years after that. I think these estimates are pretty high, so I might be more conservative and use my own growth estimates. I do think Nvidia will grow very quickly over the next 5 years and will achieve around 30% growth in cash flows. But for the 5 years after that, I'll assume the growth continues but slows to around 15% a year. For our discount rate, because Nvidia is a pretty stable, low risk company, we'll give it a discount rate of 10%. And for the terminal value, as Nvidia is a high growth and high quality business with a relatively long runway ahead, I'll assign it a terminal value of 25. Now the calculator has done its thing and it's given us an intrinsic value market cap of 890 billion. For the per share amounts, the last value we need is the shares outstanding. If we go to Ticker, go back to overview, we can see that the shares outstanding is 2.496 billion. So if we put in 2496, we can see that our intrinsic value share price is $356. Now we may be wrong about our estimates for Nvidia, so for our buy price we'll give ourselves a nice big 50% margin of safety, which gives us a buy price of $178. So around 180, that's our buy price for Nvidia. If we look at the price currently, at the time of recording, it's about $220 a share. So it's a little over our buy price and I plan on being very patient and not budging from that price. However, if it comes down to $180 or below, I'll definitely be loading up. Before we move on to another example, I want to quickly show you how this calculation would have looked if we used the 10-month-old data. Just to show you how not using current numbers can really mess up your valuation. So if we leave everything as it was but change the free cash flow to the older number, which is 4.7 billion. Now it's saying Nvidia's intrinsic value is $176 a share and its margin of safety buy price is $88 a share, even with the same exact growth rates. So always make sure to use the most current numbers possible to be as accurate as possible. With valuation estimates, you'd rather be reasonably accurate than precisely wrong. So let's move on and do another example for Tesla. When valuing a company like Tesla, I prefer to estimate their actual production growth, profit margins and average sale price of their vehicles, instead of using an arbitrary growth rate figure like 10% or 30%. I believe it's way more accurate that way. For Tesla, I believe their growth rates will be 46% for the first 5 years and 17% for the following 5 years. In my next video, I'm going to show you all this research in detail for Tesla and I'm going to do a deep dive on how I got these numbers, but for now let's just roll with it and do the valuation. First, we need the most current possible free cash flow. So let's head to Ticker. Like before, let's go to estimates and drag the line up to the current year until we have one actual and two estimates. We can see by the dates that they report earnings in December, so we're only 2 months away from this year's report. And it says here that they're estimating 3 billion in free cash flow. Now I actually think the Ticker analysts are undercutting Tesla a little bit, and I personally believe that Tesla will do around 3.5 billion in free cash flow. So we'll use 3.5 billion in the spreadsheet. Again, for our discount rate, we'll use 10%. And for our terminal multiple, because Tesla is such a quality business with massive growth, as well as having a really long runway, I'm going to assign a terminal multiple of 30. That gives us an intrinsic value market cap of 720 billion. To get the per share amounts, we just need the shares outstanding. If we go to ticker and go back to overview, we can see the shares outstanding is 990 million. So I'll go back to the spreadsheet and type in 990. Now we have an intrinsic value share price of $727 and a margin of safety price of around 370. Based on the current price at around $850, Tesla is currently a fair bit above my margin of safety price. I personally believe Tesla can execute on these growth rates into the future, and my intrinsic value for Tesla is roughly between $600 and $800 a share. It kind of depends on how some things play out, like the cost of full self-driving and many other factors. So that means to buy Tesla for a 50% discount, you'd have to pay around $400 a share. If it seems impossible it will ever reach that price, be patient. All great companies go on sale from time to time. Phil Town, Monish Pabrai and many others say that great companies go on sale all the time. You just have to be patient, demand a margin of safety, and eventually it will reach a price that you find attractive. And when that happens, be ready to pounce. The best times to buy stocks are during crashes or times of panic. When that happens, almost every company in the stock market goes on sale, and it's almost like a flash Black Friday sale for businesses. And you never know when it's going to happen. So it's important to always be ready for an opportunity. Again though, I plan on staying patient because I believe that at some stage the price will fall to near my buy price and I can buy more shares. The reason the stock price is trading at a high price relative to its fair value is because everybody knows how great Tesla is. Almost every investor knows how fast it's growing, and therefore everybody wants a piece of it no matter the cost. This short-term thinking, emotional popularity contest by Wall Street and other institutions pushes stock prices either above or below their fair value. When everybody loves a stock like Tesla, nobody is going to sell their shares at $350 to $400 a share. In order to get at those prices, the popularity needs to shift, and most investors need to hate Tesla and be rushing to get rid of their stock. And that's when people like us can scoop it up for a massive discount. The absolute best time to buy Amazon, and probably the only time in recent history where its price was trading at a massive discount to its fair value, was just after the dot-com crash, when people were dumping Amazon like no tomorrow and everybody hated it because it was a tech stock. In November 1999, Amazon was trading at $100 a share. Let's say you thought its fair value was $50, so our margin of safety buy price was $25. You might have thought back then that there was no way that Amazon hits $25 a share. But if you were patient and you waited until the majority of Wall Street hated Amazon, let's fast forward and see what happened. If $25 was your buy price, you could have waited until the crash in 2000 when Amazon was trading at $20. If you were even more patient, in November 2001 it was as low as $7 a share. For that to happen, pretty much all of Wall Street needs to dislike Amazon and think it's going to fail. That's the only way these prices happen. And you really have to be sure of yourself and be sure of your research to buy when everyone around you is selling. You really need to understand the business, its moat, and especially its intrinsic value. If you had bought $10,000 worth of Amazon stock for $7 a share, you would be a very, very wealthy person today. As today, Amazon is trading at around $3,400 a share. A more recent example of a massive misprice is Alibaba. Let's look at a DCF for Alibaba and see what we find out. So I've used this year's estimate of 25 billion in free cash flow. I've used 15% growth for the first 5 years and 12% for the following 5 years. Based on their big five, this is pretty conservative and they could easily hit 20% a year with their cloud business. I've also used a 10% discount rate and a 25 terminal multiple. Based on 2.7 billion shares, it tells us the intrinsic value share price is around $430 a share, and our margin of safety buy price is around $214 a share. If we compare this to what Alibaba has been trading at recently, we can see a big discrepancy between the fair value and the actual price. It's been as low as $130 recently. Due to some regulatory changes in China, investors no longer like Alibaba and they're rushing to dump their shares out of fear, which crashed the price far below its fair value. This leaves opportunities for investors like Charlie Munger, Monish Pabrai and many others including myself who believe that these risks are overblown and that Alibaba is still a terrific company. And people like us are happily buying at these crazy depressed prices. Which one of us is right? Who knows, and we'll find out in a few years if we were right to buy or if we should have sold. That's the beauty of investing. We'll all be proven right or wrong sooner or later. Another company that I currently own that's been getting a lot of shit in the market recently is Corsair. If we look at a DCF for Corsair, based on reasonable growth rates of 12%, their fair value is around $50 a share, meaning their margin of safety price is $25 a share. and recently their stock crashed to $25 a share. This was due to the CEO reporting that they're experiencing higher than reported shipping costs, which led to them lowering the profit expectations slightly. One person might think this is terrible news and sell the stock, whereas me, on the other hand, I think it's great that the CEO is telling us the facts straight up. He could have not said anything and let it surprise us later at earnings. Again, I think it's an overblown risk, and I'm really happy that the CEO decided to tell us the facts instead of trying to hide it. Because I understand the company, I believe it's a short-term hiccup and it's allowing me to buy shares at my margin of safety price. When it comes to buying shares in businesses, Warren Buffett says the best time to buy shares is when there's blood in the streets, when everybody is panicking and selling. It's also the most difficult part of being a value investor, because it can be difficult to be against the crowd, especially when the majority are against you. You have to really believe in yourself and believe in your research. The best investors in the world don't care what everyone else is doing. They just stick to what they know. They stay within their circle of competence and they buy dollars for 50 cents. And they know that it's worth $1 because they researched it thoroughly and they understand it. So that's it, guys. You've made it to the end of the series. I've left both the spreadsheets in the description box below so you guys can download them and have a play around yourselves. I remember when I downloaded my first valuation spreadsheet from Investing with Tom, and that was the moment that I really felt like a true investor. And hopefully you guys can start analysing your own businesses and finding your own 50-cent dollars. Let me know down in the comments below what companies you're researching, or if you have any questions at all about the valuation process. Now before I go, I want to be completely transparent about what stocks I currently own in my portfolio. So the stocks I currently own in my portfolio are Tesla, AMD, Corsair and Alibaba. Those 4 stocks make up about 95% of my portfolio, with the remaining 5% just being in ARK ETFs. And with those 4 core companies, I can confidently say that I bought each of those companies for around 50 to 60 cents on the dollar. I'm only showing you guys this because there's a lot of content creators that talk about stock picking, but they don't talk about what stocks they own or show their own portfolio. I do understand it from their perspective, but I prefer people who are straight up about what they own. That's just me, and I prefer being transparent with you guys. As you know, buying a stock without doing any research just because someone else bought it is a really bad idea. So this video is not a buy or sell recommendation for any stocks I said in this video. It's just my own opinions and research. So as always, this video is not financial advice, and please always do your own research before making any investment decisions. Now that this series is done, I'm going to be making videos where I show my research for different companies that I've been analysing and sharing my thoughts on them. In my next video, we're going to be looking at Tesla, and I'm going to do a deep dive on all my Tesla research. If you've watched the video all the way to the end, thank you so much for watching. If you enjoyed the video and if you want to support the channel, please consider hitting that like button. And if you want to see more videos like this one, hit that subscribe button and tap the little bell there. I release videos every fortnight about everything investing. I just want to quickly thank the people who've been watching my videos, have subscribed to the channel and have been supporting me so much since I started the channel in February. I really value your time here, and thank you so much for giving me the opportunity to talk about something that I love. The channel has grown so much since I started in February, and I just want to thank each and every one of you from the bottom of my heart. I'm so grateful to each and every one of you. One of my aims when I started this channel was to create a community of like-minded people where we can discuss investing strategies, talk about businesses and grow our wealth together over time. It's been so fun chatting with all you guys in the comments, and soon I'm going to create a Discord server so we can actually have a place for our community to meet up and chat. It'll also be a place to share ideas and ask questions too. Let me know below if that's something you'd be interested in. So that's it for this video and for the whole series. Thank you so much for watching, and I'll see you guys in the next one.